Jim, we spent so much time last year talking about the bond market, the inverted yield curve. You were one of the leading analysts who was talking about the Fed having to listen to the bond market, right? And they did. They cut 3 times. What about this time?
It's the same thing. The yield curve is inverted again, and the bond market is pricing in another cut by summer, June or July, take your pick at this point. I think that the market is anticipating some kind of event, a virus event, that is going to slow down the economy, and that there will be some kind of Fed action coming off of that right now.
Is there speculation in this assumption? I mean, right now it's like, nobody wants to downplay the effect of what's happening from this virus, but at the same time, we don't even have any numbers, right? Even Apple said, look, we're not going to meet our guidance, but we have no idea how much they're going to miss. We don't know. We don't have any GDP updates or anything yet.
Yeah, there is big speculation on it. The great line I've heard is that the bond market is railing on the fear of coronavirus, and the stock market is railing on the hope of coronavirus.
Right.
The hope that it really comes down to, are we talking, we're going to get into the letter debate, right? Are we talking about a V bottom? Are we talking about a U bottom? Or are we talking about an L bottom? I think that,
For the global economy?
For the global economy, yes. I think that the bond market is more in the U or L camp, and the stock market is more in the V camp. And that really comes down to the question. The question is not, will...
Interesting way to put it.
There's not really a question of, will there be an effect? We know that already.
Yeah.
Apple already told us that. The question is, how much? How many quarters? How long lasting will the effect be? The dollar rallying, commodities slumping. I know they're not in the last couple of days, but since late January, commodities slumping and bond yields falling around the world, inverting the yield curve. All of those are more like U or L. Stock market is more V. That's really the question as to which one we're going to get. As a bond guy myself, and being that I've seen these questions come up before, 2008, 2011, 2016, I tend to lean towards what the bond market is telling us. So I tend to be a little bit more in the camp of it's probably looking more like a U or an L, and that's going to push the Fed towards easing. I know Clarida didn't say he was going to do it. He didn't say it. But he's got to wait for the data to show up, and that's what the market's betting. You'll see. Correct
me if I'm wrong. It sounds like, Jim, because we've been talking for a while now, the past year and a half or so, you don't sound like you're quite as rushing to the need for cuts this time. Because when we had this conversation last time around, you made a very compelling case. The Fed, it was obvious they were out of line, that they needed to get in line. I don't quite hear that same conviction this time around.
Right.
Am I wrong?
No, you're not wrong, because what I'm afraid of is, I don't know what Fed cuts are going to do other than support the market. There's a joke in the marketplace that the answer to every question in Wall Street is either it's bullish or they're going to print money.
And right now, this is my chart that I've been running. This is the Fed cut odds for June versus VIX.
Yeah.
To me, it suggests that maybe the market is not too crazy about cuts, but we don't know which is the dog, which is the tail here in this situation.
We don't know that. You're right, but that's why I'm so unsure about these cuts. I mean, the Fed will respond knee-jerkly and cut to support the market. It's not going to support the economy. If there is a problem with the global supply chain, you print all the money you want. You're not fixing that problem. You might be able to support the stock market. It doesn't help that problem. So that's the hesitancy. Last year, the problem was rates. And so the argument for a cut in rates made sense. This year, the problem is beyond rates, but you're going to be using a tool that may not help, but that's the only one they've got.
Right now, we've got the data here is just crushing expectations. I mean, even if you combine the U.S. with China and the Eurozone, we've totally lost the Eurozone beat rate. It's fallen off a cliff.
Right.
Together, the economic surprise indexes were at the best since 2018. But actually, because the U.S. has been hitting, there's our chart, we're still up there. The U.S. has totally been offsetting the Euro decline. And now we've got a situation where yields are going down while inflation's going up. These are inversely related the past year. Is this because of the cuts? Should we be worried about this relationship?
Yeah, first of all, on your first point, you're right. If we didn't have this virus, I'd be here telling you, man, this data looks good. This data looks good, with the exception maybe of earnings a little bit.
Yeah.
But that could have been overcome anyway. The question we really have is, are we at a serious break? This is all pre-virus stuff, and that was great, but we're talking about what's coming next. And that's really where the market is really struggling with this question right now. So yeah, you look at the housing numbers with blowout numbers, and, and you look at some of the other numbers and you go, yeah, that's the old era. Is that the old era, or is that the era that we're in? Even Philly Fed, you can look at that and go, is that the old era, or is that because next month starts a whole new era as well too? So that's going to be the real struggle as we go forward. Like it or not, we're all going to be virologists for the next month or so.
Some people have jumped even further ahead. One of the things that's happening right now, of course, is I know this has been going on for a long time, which is that stocks and bonds generally rallying together. In an era of lower and lower rates, that totally makes sense. Are people being too dismissive of that relationship still happening, and to the degree it is right now? Because your point about last time's cuts being very obvious compared to this time, it sounds like, again, I've described it as kind of this nuclear race in bonds and stocks. You're describing it as one expecting fear on Corona, one expecting hope on Corona. Can we dismiss this 3-month-long everything rally again because the last 30 years has been this way?
No, I don't think we can. If this rally continues, look, I can't tell you what the virus is going to do for the global economy. And if it is as big a deal for the global economy, this everything rally won't last much longer. But if it isn't and it goes away, this everything rally can last, because it is, as you pointed out, it's coming on good data, low inflation. That's why bond yields are low around the world. I know it's easy for us to say it's all central bank fault. The central bank can only do so much. You have to start with no inflation and the prospects of very low inflation, and that really sets the stage for very low interest rates.
You're not impressed by PPI?
Not yet. Not yet. I mean, the numbers jiggle along the way. But we haven't had really a real serious inflation in the U.S. economy for 15 years.
Yeah.
So I do think that the everything rally is continuing on these two theories. You tell me what coronavirus is going to do. If it's a big deal, I think it ends. If it isn't a big deal, it might continue a little bit longer.
Yeah. Is there a risk then that we will have to see the aggression with which the Fed cut? Is there a possibility that they'll have to have aggression on the flip side if the trend continues with yields moving lower despite inflation climbing, even though it may not be alarming, the 2.5%? I mean, the CPI chart looks like this over the past year.
Yeah.
And the bond yields look like that. So if the Fed then, are they going to get caught behind on the other way?
Yes, that's a very big possibility, because let's remember what's happening. The tightest central banks in the world are the emerging markets. They're the ones that are going to open the spigots the widest. The Chinese have already started opening the spigots to a record that they've already had. The Singapore, Taiwan, South Korea, even Australia said, we're going to open the spigots and we're going to go. If this virus turns out to be nothing much, then we're going to have an inflation problem on the back end, because they will open up the spigots for the Fed. But if they're opening the spigots to try and buffet a big slowdown in their economy, will hold back the inflation. So the Fed could be sitting there doing nothing and going, those guys just pumped money like crazy, thinking that this virus was a big deal. It wasn't, and now they produced inflation that we're going to have to respond to. So even they have to be sitting there. This is a game of 3D chess for them.
Yeah.
We haven't had these kind of issues with these kind of black swan events like a virus. We're still trying to figure out what it means.
One of the more interesting charts I want to get your take on, I don't know, maybe it's not interesting, but it's basically the 10-year German bond yield versus the Treasury bond. And I've got it basically over the past year and a half, and it's normalized as of the 10-year bottom in September. Because I think the explanation we hear a lot is, hey, yields are low because the rest of the world is low. Well, actually what this chart shows is over the last, 7 months, basically, the bond yield's got a little bit more elevation than the Treasury. I mean, can we blame Germany as easily now?
No, I don't think we can, but I do think that this chart is very important. There's been an argument to be made that the two most important indicators on setting the level of interest rates in the U.S. are the growth rate of the U.S. and this spread. And this spread is because there's only so much. Whenever I talk to bond people, they go, wow, I think that the bond market's ridiculous at 150 on the 10-year note. It should be much higher. And I always just say, well, it can't go much higher unless you're going to give me if you want it to be 250, you need to give me the bond yield up 100 basis points too.
Right.
And so that spread is one of the more important spreads. Now, you're right, 10-year bonds have rallied a little bit more. Of course, they started at such a ridiculously low level at minus 70 basis points right now. But that does give our rates more room to move up if we get this virus out of the way. If we don't get this virus out of the way and it winds up being this thing that hurts the economy, then the rally will continue for a while.
What do you think will be the most convincing event to get the Fed on board if we're still hovering with yield curve inversion? Is it just a stock sell-off? Is that as simple as it is now?
Yeah, I hate to say it. I know that the Fed cringes, but it is. Are they the central bank of the S&P 500? Because they seem to act that way quite a bit. Beyond the stock sell-off, I do think the next thing that everybody's going to watch is the world as opposed to China, because you've seen some of the infection rates in South Korea and in Japan, in Singapore, start to move up, especially in South Korea, a lot. And if over the next couple of weeks we start talking about quarantines in those countries, that'll get the Fed to move, I think. Yeah. Not cut rates, but move their thinking towards cutting
Being a little bit more open to it.
Yeah, exactly. Yeah. That will be a game changer then for them.
Anything I missed, Jim? What are we missing?
Nothing at this point, other than that gold is acting like it does, like it's supposed to. In a harbinger of uncertainty, it seems to be a place to go, and that's why you've seen the multi-year high in gold, and I think it will continue to move higher. And the electronic version of it, Bitcoin, will probably follow irregularly with it as well.
Should gold bugs, and maybe even the Bitcoin bulls too, throw out the idea of them being inflation hedges, since they're up so monstrously since the spring of last year, when, as we were discussing, there's no runaway inflation yet?
Right. I don't think that they've ever been inflation hedges. I've always thought that they've always been calamity or uncertainty hedges. Now, one version of that is inflation, but it's not the only version of that as well, too.